Wait a second, and go.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, nor any of their respective offices, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OTC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone.
All right. Hey, they just did the 20-year auction and they sold 20-year bonds for 1.2%. So that's the going rate now if you want to buy bonds. I don't know why anybody on the planet would want to buy bonds, but if you want to buy bonds, 1.2% is what they'll pay you for the next 20 years. That's why we're starting this new hedge fund. We have this hedge fund we're setting up where it's the idea is to produce an income, sort of like the butterfly portfolio does. So look at that, almost 40% on the long-term portfolio. Let's see if we can get if we do a refresh, if it helps. Dun, 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 it's like the telephone. Oh, 39.4. We'll get there. I have faith. All right, that's amazing. That's up from 20% last week. So that's a 20% gain in 1 week on the long-term portfolio. So thank you, Mr. Trump. You know, he's making it great. Nothing even happened. We did the frickin' review on Friday. Well, okay, something happened. We did the review on Friday. Friday afternoon, we did the review. So somewhere between here and here, I was writing up the review. And we finished, you know, well, at the time I printed it, which was 1 o'clock, so probably around here, when I you know, I'd have to take a snapshot of the portfolio and put it up. So when I took a snapshot of the portfolio about 1 o'clock, it was, we were here on the market. So that's under 28.50, and now we're at 29.60. It's only up 100 points, only up like 5%. 5% gain in the S&P, and we're gaining 20% in the portfolio. That tells you how leveraged you are. Now, the nice thing is the short-term portfolio hasn't really lost very much money. So that's good too. Down to 432, but 432 is very good. That's 532,000. And the LTP is like at 800,000 now. Is that right? 700,000. So 700,000 plus 532 is 1.232. We're up more. It's still going up. So we're losing less in the short-term portfolio than we're gaining in the long-term portfolio. So we're steadily making money, even though we're maintaining ourselves very well hedged, which is what you're supposed to do. I mean, you try to be balanced, but you also want your hedges to keep working. You know, you got to maintain those hedges. Otherwise, you're not balanced. You think you're balanced and you're not. And as I pointed out yesterday when we reviewed the short-term portfolio, some of the hedges aren't working. You think they're working, but then you redo the math because like SQQ went down to 10. And the problem with SQQ and any kind of ultra is now that it's at 10, even if the S&P drops 30%, now SQQ would, I'm sorry, even if the S&P only drops 20%, now the SQQ, which is a 3 times ETF, is only going to go up 60%. But 60% of 10 isn't enough money to make your hedge work. That's the problem. When it was at 15, 15 and 60, 15 times 1.6 is 22. So 22 was fine, but when it drops from 15 to 10, your hedge doesn't work anymore, because it's not just that it dropped down $5. It's that the 60% of 10 isn't going to get you where you want to be anymore. So everything has to be changed. You've got to be cognizant of the math. You've got to always be working out whether or not this is, each position, not just a hedge, but every position should be mathematically checked to say, is this doing what I think it's supposed to do? So anyway, I was saying, so we have this hedge fund where, of course, this is why it's important. When you have a hedge fund, you've got to constantly be doing this. In the butterfly portfolio, which is very reliable, that's dividends, still terrible. Butterfly, actually, down 23 is not terrible. It's recoverable anyway. Oh, wow. No shit. Is that an error? What the hell happened here? Nope. I'm looking to see if something expired or something weird. Why did we make so much money? I don't know. When did I do it? Butterfly portfolio review. Comments. Butterfly. Hands across the water. Here we go. Nope, short term. There it is. So we were at 443. Oh, it was up 121%. I didn't realize it was up so much. Okay, so we were 443. Now we're a little bit high. Now we're like 445. That's no big deal. I thought this made a huge gain somehow. Now we're at 450, so $7,000. But it's only, it's in a few days. Generally, we don't expect the butterfly portfolio to move that much. So that was 512, and what are we at now? 520. So it was a week ago. All right, that's about right for a week, I guess. Anyway, so we're looking at positions, but the point is, the butterfly portfolio is the only one we kept from the old days. So from this is still going from January 2nd of 2018. Why? Because even in September, when I was sour on the market, and we cashed out our portfolios, there was no need to cash out the butterfly portfolio. It doesn't care which way the market goes. It's very neutral, and it's generally going to make, this is now 2.5 years, and in 2.5 years, it's up 120%. So it makes about, realistically about 40% a year. It's designed to make 30 to 40% a year. So what we're going to do is we're going to build a hedge fund now, and the hedge fund is going to make, it's going to run like the butterfly portfolio, but we're going to do it so that people who, obviously you don't want to put your money into bonds. It's for people who are retired and want to draw a steady income. So every quarter, we're going to make payouts. So instead of a fund that just only gives you money when you ask for it, we're going to plan the fund around using this kind of butterfly portfolio system to make payouts on a quarterly basis, but only small portions. So 2% basically is going to get paid out per quarter, which is a lot compared to a bond fund or something like that. But it's nothing in the butterfly portfolio. You're paying out about 1/3 of the profits. What that'll do though is it won't, it'll lower the net. We're probably not going to get to 40% a year because we're paying out 8%. Therefore, we're not reinvesting that money. But if you're making, if you're getting paid 8% a year and you're still growing your principal 20% a year in the background, that's fine, right? So I think we could run a very nice steady fund that's going to be a lot better than all these stupid retirement accounts. And there is trillions of dollars sloshing around out there for people. So if we can get a good running start on a fund like this and prove it out over the next year or so, I think this could turn into a massive fund. So we're very excited about this one. This is going to be good. So, you know, it's a simple concept because look here, let's look at the butterfly portfolio and think about what we're doing. Actually, I already made changes. They're not reflected here yet. I haven't gotten around to making them in the portfolio. It would be silly not to sell the July. Okay, so exactly what this is, right? Here's the Disney position, the same as it is now. I mean, the same as it is now in the portfolio. So we haven't logged in the changes yet. It takes me a long time. It would be silly not to sell 15 July 115 calls for $295 and make a little side money. All right. So since we're selling those, let's sell 10 of the July puts. So we're selling 10 July puts and we're selling 15 July calls, 115s, for a total of $7,000 something. So between now and July, we're going to have 7,000. We're getting the cash now, but between now and July, we have a $7,000 potential gain. Disney's at Disney's at 117. So bottom line is on Friday, we made this call. We now have $7,000 to distribute out of the fund. So let's say that this fund is representative of somebody who put in, we started with $200,000. So let's say that's representative of someone who put in $200,000 2 years ago. Now it's $450,000. How much are we paying out on? We just on Friday on Disney alone collected $7,000 that'll pay off between now and July. Now, maybe it'll win, maybe it'll lose. It doesn't matter. The point is we now have $7,000 to hand as a distribution in the fund. $7,000 is 2% of $450,000. Well, not quite $9,000, but you get the idea. So right there, just that one little sale generates enough money to make the fund payout for this. You know, again, extrapolating the whole fund would be the same situation. So just that one sale makes enough money to pay out the fund. And what did we do exactly? Let's think about it. We have a Disney 85-120 bull call spread. We bought the spread for $50,000. See, $55,000. The spread is now $100,000. So the spread's up $45,000. That's reflected here. Okay, that's reflected that's part of the reason this portfolio is up so much. Now we're going to use that spread. So but even though it's up 55, even though it's already up $45,000, it's $100,000. So even though it's already up $45,000, it's a 45. Whoa, I can't do that math. It's some big money. It's 35. It's 35 times 5,000. 175. It's 175,000 spread. So this spread still has $75,000 room to gain. So our upside protection against short calls is $75,000, right? We're not going to lose any money. We still have the money we have. The gain is locked in, but we also have another $75,000 left to gain. Where are we? We're here, yeah. So while we're waiting, we sold 15. Now that's 15 out of 50. That's only a 1/3 cover. It's very, very, very unlikely we're going to get in trouble selling 15 short calls against 50 long calls, even though they are covered. Because like I said, we have $75,000 to gain. $75,000 against 15 contracts is $50 per contract. So Disney would have to go over 50 before we even get in trouble. Disney would have to go up $50 between now and July. It's extremely unlikely to happen. That the total high of Disney was 150. So it's not likely to rocket back up to where it was before. I mean, somebody could buy, you know, Warren Buffett could buy the whole company or something like that, but it's not likely. And of course, obviously, it's not just Disney that we sell. We do it with many stocks, but the point is we're covered, we're hedged, and we're collecting cash. And in the butterfly portfolio, we don't purposely, we're just accumulating value in the butterfly portfolio. But now I said, because I was talking to Doug, who's our head trader at the fund, and we talked about this a month or so ago when I had the idea, because I had the idea because my mother has Raymond James, and Raymond James used to pay her, 10 or 12% a year. She used to get checks from Raymond James, and basically what they do is they don't touch the principal, but they pay you whatever they can out of what they make in the fund, basically. So your principal stays pretty steady, and they pay you the money. So she's got like 300,000 in the fund, and usually she'll get like 7% a year. So she'll get like checks for $18,000 or something like that at the end of the year. Or I think it's quarterly. I'm sorry, it's quarterly. So she gets a few $1,000s a quarter or something like that. So she got a check the last time for $1,000. And she's like, what am I supposed to do with $1,000? She goes, it doesn't cover any of my expenses. She counts on that money. And this quarter is going to be even worse. So there's going to be nothing. So she's going to have a terrible, terrible year. And her friends, she's freaking out. Her friends are freaking out. Everybody's upset. And these people all have $100,000, $300,000, $500,000, $2 million. They've all got lots and lots of money in these funds. And I'm talking about, like, if I look at my mother's development, there's 500 homes in her development. They're all in the same freaking funds, all wishing they had more money as a return. So I'm like, oh, there's a business opportunity. So I started talking to Doug, and I said, look, if we follow the butterfly strategy and purposely at each quarter we say we time it, we just time it. That's all we're doing is just timing our sales to say, okay, we know that the June 30th we need to have X amount of money to pay out. Therefore, we're going to time some sales and time some expirations to come in there and fatten the fund up so that we have the money to pay out. And other than that, though, we're just running the normal butterfly portfolio. What's the normal butterfly portfolio? Well, we sold the puts, we sold the calls. They can't both expire in the money. One of them has to expire worthless. Whichever one doesn't expire, they might both expire worthless. If we're between 95 and 115, they might both expire worthless. If it's over 115, we roll the 115 calls to the next quarter. If it's under 95, we roll the $95 puts to the next quarter. Either way, though, we don't feel that that's why it's in the butterfly portfolio. There's stocks that we don't feel are likely to bust out of their range. And by the way, it's not just that, though, because obviously Disney did bust out of its range. Look how good Disney was as a candidate. Here's Disney chugging along in a range, perfect for the butterfly portfolio. What happened, though? The market crashed. But you know what? The market crashed, and because we saw why it was crashing, we already pulled out puts from Disney. So we didn't get stung by the puts. You can say, oh, you would have gotten burned here. No, we're not idiots. We don't just leave the puts on. I mean, that would be really foolish. It's when we see something breaking down, when the premise changes, we move it. So the strategy is even more effective than it seems because we're able to make those decisions, because we're able to change our mind. Just like you see on this Disney position. Well, actually, we added this on 323, but this Disney position on 323, we had something else, and we closed it down, and we flipped to this because it got so cheap. Whoop, wherever the hell it is. It got so cheap that we were like, oh no, we have to do this, and we established a much more bullish position. Then when it went up last week, I said, okay, now it's high enough where I want to start selling again and start drawing an income. So, generally we like to buy things, then channel trade them and make our money selling puts and calls. In this particular case, anytime it's happened before, it happened in the last portfolio also. When we have a strong dip and we have a bullish opportunity, we take it. We're not crazy. We're not going to let it slip by and say, well, that's not how we trade the butterfly portfolio. No way. When there's a great opportunity to set yourself up with good positions, you take it, because that's why we have this outside gain. We're only looking to make, realistically, we're targeting 20 to 30% gains in the butterfly portfolio annually. We always exceed it, but that's because we're willing to make these changes when they come along. The realistic return of the butterfly portfolio is 30 to 40%. We set it up to make 20 to 30%. Then we take advantage of opportunities. The great thing about the butterfly portfolio, though, is almost no matter what the market does, we're able to make some money doing it, because the volatility increases are great for this portfolio. So down markets tend to work themselves out. The only thing is, though, the balance of this portfolio did go down by I think it was down. It was somewhere in the 50, 60% range at one point. Why? Because we sell so much premium and it made it look terrible. And the only way it would have, I mean, but they were, if you analyze the spreads at the time, we talked about this when it was down there. If you look at the spreads, you can see that they're not that bad. It's just the premiums of the spreads had gone crazy. And that's when you're either going to take advantage of something or you're not. And so we took advantage of it. We repositioned more aggressively on things. What else did we change? So that was our adjustment for Disney. Apple we didn't touch. Amazon we didn't touch. Mondelez we sold 15. I see. Notice a theme here. Even without having the fund and having the pressure where I need to sell stuff, I'm still of a mindset where I want to generate cash. So I said we may as well sell the 5250 calls from Mondelez and see how it's actually trended flat along this line. I said we sold the June puts. Earnings are not till August 1st. I don't think the company was affected by the virus. We may as well sell the 5250 calls. So at least we're generating some cash off this thing. We don't have a 2022 cover. We're in known danger after the sale, and it's at $19,000 position. We paid $605.04, so it's up 200% already, and generating 33% more of the 6,000 original. Getting 33% more for 2 months is fantastic. The MJ ETF, we sold the July 12 calls, and they're flatlining nicely as we expected. And Whirlpool, we sold 5 September 120 calls because we figured that was where it's going to stop going up. Because, well, it stopped going up there last time. Why wouldn't it stop going up there this time? What's different? And that's the stuff I've been writing about today in the articles. Is I'm like, look, more so. Well, we'll talk about that next. So look, this strategy that the government is following, treating us like soldiers going off to war and just seeing how many people get infected, is a little bit insane. And we had a longer discussion about that. Oh, what happened to my infographic? It didn't work. I had a nice infographic there. Anyhow, so there was a cool infographic, and we're talking about how we're in a recession. This crazy market going up and up and up is irrational. We're in a recession for sure, global recession, potential depression. And he always like the impact of a recession on hospitals, which are considered one of the safer areas now. Remember, we got rid of our tenant health care because I said I'm worried about the hospitals. Here's a nice graphic about that. The recession causes less people to go take care of stuff. That's all there is to it. People don't have money. We're not like Europe. You can't, if you're sick and you don't have money, you stay sick in America. And I know that sounds insane to those of you who are in Europe. I know that sounds like an insane system. But yeah, if your heart hurts and you have pains in your chest and you don't have medical insurance, you just wait until you die. You are not going to get fixed. You can't afford it. I know people. I have met many people who have been sick, and it's and also particularly in the heart things, and have been like, oh, I have this pain in my chest, it's some kind of chest pain. I'm really worried about it. But you know what they're most worried about? They're most worried about that if they go to a doctor and they complain, the doctor is going to force them to go to a hospital, which they can't afford. So they don't say anything. They don't do anything. It could be totally preventable, and people walk around with like the most horrible medical conditions because the worst thing that can happen to them is to have to go to the doctor. Not only do you have to go to the doctor, and the doctor sends you for tests you can't afford, and the tests send you to the hospital, which you can't afford, but then your job isn't secure. We have no job security, as you can see right now playing out where the Republicans aren't going to fund any more unemployment insurance. And in fact, Mnuchin said, which is a sick thing. Here's Mnuchin. It all ties together. So I put the quote. Oh, I was a video. Wait a second. Oh, here it is. Oh, it's even. Here's this thing. Mnuchin said Tuesday, if the company tells you to go back to work and you feel you're at risk, if you're older, if you have a condition, if whatever, and you don't want to come back to work because you don't feel the conditions at your job are safe, Mnuchin wants you to report the employee and they will be cut off from unemployment insurance. They are not considered unemployed. If your company's open, you get your ass back to work. That's basically what he's saying. It's mind-boggling. I'm sorry to laugh because it's really horribly tragic, and I know it affects people who you probably know. But I mean, this is just the most insane freaking thing I've ever seen, and we're like living through it. And it really is. It's like you see this stuff in movies, and you're like, well, that can't possibly happen in real life. Yet here we are in real life, and it's happening. I don't know what to say. It's crazy. All right, so other recessionary stuff. Layoff anxiety. All right, this is an old poll. This isn't current, but it's believe me, it applies. So half the employed Americans suffer from layoff anxiety. Losing a job, 40% have been laid off or terminated from a job at least once. That's especially true after the last financial crisis. What fuels anxiety? Fear of recession. That's rational. Office rumors. That's going to happen. And recent layoffs. Well, we got lots of those. This is back from the last recession. Nearly 3/4 of those who experienced a layoff termination during the recession say they suffered from layoff anxiety, particularly due to fear of pending recession. And here we are in another recession 10 years later. Young adults suffer from layoff anxiety. Yeah, I talked to my daughters about it. I think it's just because you never got laid off before and you think it's going to be like so horrible. I mean, why don't you just go get another job? But yeah, it's both my daughters are like freaking out about losing their jobs. They both lost their jobs. So Jackie is now, they're only in college. Jackie is now, Maddie is freelance artist, doing freelance artwork, and actually, not doing great. So I supplement her a bit, but she's doing freelance artwork. Jackie started working for DoorDash, and she's having a great time. She loves it. So for her, she's making like, I'd say $15 an hour doing DoorDash. It's really not bad. And in fact, she's down in Florida right now visiting, and she took a couple of jobs. She made some money while she was down here. All you got to do is sign into the network and just go boom, and they give you things to pick up and deliver, and you're done. Current workers feel they are ill prepared for potential layoff. Well, yeah, obviously. I don't understand what prepared means. I mean, I guess having money in the bank or something. I don't define what prepared is. All right, well, anyway, that's talking about how people are prepared for layoffs. Then it says new homes. Now, home prices, that's another thing. You haven't seen, look at this shit. This is a change in home sales volume, and this was a change in prices. So the drop in volume precedes the drop in prices by quite a bit. And then you get the drop in prices, and you can see when the home prices will come back up because the volume comes back, but you can't see when it's going to, in other words, it's hard to catch when it's going to start dropping, but you'll see when volume of home sales decreases, the sales price will eventually start decreasing too. Obviously, supply and demand, blah, 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 but whatever. But then you've got to look at, and this is hard to read. I'll see if I can blow it up. I don't think I can, though. I mean, I can blow it up, but it might look bad. Oh, no, it's not bad. Okay. So these are different recessions that they're looking at. So historically, so let's go recently first. 16.7 home sales prices down, home sales volume down tremendously, single family permits down. Well, okay, who cares? Multifamily down. That's just basically commercial real estate. And this is, by the way, being done by a real estate company, so it's very real estate focused. the 9/11 recession, 13.2 in volume at 3%. That was a quick shock though, the 9/11, right? Family permits, multifamily, not a huge impression. This is a more real recession. Then we had the Gulf War, and that led to a very small decline in prices that wasn't really affecting America much. Single family permits. The Iran crisis, also not so terrible, right? The energy crisis in 80. I'm surprised the S&L crisis isn't here. That's kind of weird. That's a weird thing to omit. 4.4. Oh, they actually had an increase in home prices during the energy crisis. You have to think of like, what is this? What is our issue most like? The Nixon recession, 6% drop in home prices, 3.5. So the one that hit us harder was the last recession. That by far hit us the hardest. And so far, I mean, we have way more people unemployed right now than we had in the last one. So it could be nasty. I mean, we don't know yet. We don't know what's going to happen, but now that the government's pulling their support and saying, just get the frick back to work, don't cry to us, that could be bad. And don't forget the market went up. Why is this not working? I'm trying to make it smaller. Oh, there it goes. Okay. So now that the market's going up, but you have other governments, we're just not admitting that we're in a recession. Other governments don't cater to business interests. And, they're willing to say, hey, the UK is in a recession for sure. There's no question about it. And our economy very, very much mirrors the UK usually. Public debt's $2 trillion this month. That's insane. That's a country, 50, 60 million people, 70 million the most. I don't know. Population. Wow, can I spell? I hate this keyboard. That's why it's on this computer though. It's on my regular computer. Population UK. I was right in the zone. All right, 66.5 million people. Where were we? Yeah. So that's a country 1/5 our size. So that's like $10 trillion for the US. And that's like $1.5 trillion that they're borrowing. So not even as much as us, but believe me, their money's going directly to the people who need it. They're a lot more targeted than we are. As Elizabeth Warren was saying yesterday to Mnuchin, like, dude, you got this $500 billion slush fund. You haven't even used the money yet. Like, if you're trying to help people, what are you doing? But what they're doing is keeping the money, basically. Japan clearly in a recession. Nobody can deny that. This is talking about the states and what they need. The states need the House passed this $1 trillion stimulus package for the states, and the Republicans just said no. Yet the market is going up. I don't get it. I don't know what they think is going to happen. I really don't. Tom Barkin, he talked about the unemployment situation and says that the data is worse. This is a guy who knows. He's a Fed guy. He knows what it is. So it's like he's saying it's way worse than it looks. CNN is talking about, CNN is just talking about what a disaster this whole thing is. Goldman Sachs says India is going to be down 45% in the second quarter. They've revised their 20% estimate to be 45%. So it's twice as bad as they thought, more than twice as bad as they thought. Yet here we are, la-di-da-di-da on the markets. It's mind-blowing. It really is. And like I said the other day, I really would have rather cashed out. I mean, it's too crazy. It's crazy, and you don't want to miss a big rally, but I don't see where the math is to keep this rally sustainable. I don't see how it can be sustained. Trump's Kudlow said that the U.S. may not impose a. Now that's interesting too. They're expecting a second wave of the virus. They're causing a second wave of the virus right now by opening everything up. But they are also saying that you know what, we're not gonna make a stay-at-home orders this time. We're just gonna let it spread. That is literally their game plan. See, Kudlow is saying we don't have to shut down because we know more. What? What do we know? We shut down last time. That's what we did. And it says we're much better equipped with the right tools. Do we have the right tools? Do we really? Do you know how many people are wearing bandanas instead of face masks? How many people are really wearing the proper protective gear in the stores and so on and so forth? Oh, there was this great thing, which I think I linked to in the post. This is I want everyone to look at this. That's where this came from. Here you go. Here, when you hear them saying other countries have opened up and it's going well, this is what it looks like when other countries open up. Okay? Here's a gym in Hong Kong. Look what they did before they open up. Barriers between every single thing and super duper, like, you know, cleaning of equipment after every time. At the same gym, a sanitizer spraying disinfectants in the air constantly, like while you're there. UV sanitizers to clean your phones. That's got nothing to do with being at the gym, but they still provide them because they want people to clean their phones. The escalators, see this thing? On the escalators, they've installed these things. This is a Danish supermarket. So this is, and this pisses me off that we don't do this here. It's a hand sanitizing station. When you go on a cruise ship, you see these kind of things too. Before you go in, you wash up. Every place, every store should have this. Everywhere you go in and out of should have these things. This is not technology. This isn't a difficult solution. Soap and water is all you need. And you need a station. So you need to provide running water. See the hose coming out of the store? Running water and soap. And then there you go. It's an outside stall. And everybody just washes their freaking hands, takes a paper towel, does that, and then goes in the store. Clean yourself up before you come in our goddamn store. In Bangkok, this robot goes around shooting, you know, scanning people for the temperature and so on and so forth. And look, see what it's doing? And that's cool. Oh, here's a Chinese student going to school. Shoes get sprayed because you walked around town. You might have the virus on your foot. And then the next station is a hand washing station. And then the next station is a spray down station. And then the next station is a scans eyes, hands, and throat in 3 seconds before you enter the building. That's how you go to school. So when you hear Trump saying, oh, they reopened the schools in this, that place, and that place, and that place. Yeah, they did it this way, though, with equipment. That's what reopening is in other countries. It's saying they took the time of their lockdown to get things in place that would allow them to end the lockdown. We did not do that at all. We're just ending the lockdown. It's really insane. It is. It's absolutely freaking insane. And it would be a lot funnier if it wasn't my life and my kid's life and my mother's life. It drives me crazy. Here's schools in wherever the hell they are, China, but barriers between each kid. Here's the, oh, look at that. They got plastic thingies here on desks. What's McDonald's? You have to stand in front of a thermal monitor before getting takeout at McDonald's. Don't come in our store if you're even potentially possibly sick. Starbucks in Taipei, automatic hand sanitizer. Tables are sectioned off with dividers. Here's Shanghai, sprays down the customers with disinfectant before they're allowed to enter. Hong Kong gives you a bag to store masks. Reusable menus are a thing in the past. So every restaurant, I just got handed a menu when I went to the restaurant the other day, and I was like, that's a little weird. I'm like, I wonder how they clean it. And so it's saying here, your menu goes to your phone. Everybody's got a phone. If you don't have a phone, they can give you a phone or whatever. But I mean, it's just crazy. It's like, why are you handing out menus and then putting them back in a pile? It's like the worst things you can do. That's a little weird. Shanghai restaurant disinfects your tableware right in front of you so you can make sure it's being done. Robots are delivering takeout. Germany has guards at the bar. Oh, that's there. That's definitely not happening in my town. I tell you that. All the bars are like just perfectly normal. Here, look, here's people in Japan. They got a barrier between the people sitting at the same table. What else? Oh, here's churches separated out. Here, oh, look at that barber. Now, I don't mind getting my hair cut by that guy. That's cool. I need my hair cut badly too. That's what reopening means. See, when it's an apples to oranges kind of thing. Because we say reopening, and you see Trump and his people saying, "Oh, this place reopened and that place reopened." It's like, yeah, but that's how they reopened. They reopened as a totally different system with strict precautions being put in place. We're reopening by just saying, "Oh, forget it, go out. Okay, time." It's like the air raid left. It's like the air raid siren got blown, and everybody goes back outside. It's crazy. Let's see what anybody else has to say. Nope, not many questions. Bernie says, MU, strong demand for NAND storage. Any good setup on MU? Micron. I like Micron a lot. Are they cheap? I don't know. They're about where they usually are. That's weird. Okay. I don't know. You have to remind me and check. That's I got to really look at them then, because it's not going to be an easy thing. Where's my Yahoo? Yahoo. MU. Yeah, PE 22. I mean, not terribly exciting. I mean, I do like MU. And if the VIX was higher, I'd probably be more excited. I mean, I don't think they're a bad stock. I would even consider them for the butterfly portfolio, given the way they've held up in the channel. And you don't count this. I don't count that. It's like, so basically between 36 and 56 is a pretty reliable zone. So if you play them at 46 and you allow for 20% up and down, that means we can make money constantly on all these swings. That's what the butterfly plays are all about. I don't need it to stay exactly flat, but I need it to be in a range so that I know, like, oh, it went pretty high, so I'm going to roll my calls and I'm going to wait and be aggressive with my call selling. Then it goes really low and I roll my puts and I be really aggressive with my put selling. And then I do that and I wait on the calls and maybe I buy some more stock down here. It's very simple to make these decisions. You just have to buy good, reliable companies that have a tendency to play in a channel. That's how you play the butterfly portfolio. And believe me, there aren't many companies like that. And they have to have the kind of state you want them to have swings. You don't want them to be too flat. If they're too flat, the option pricing isn't very good. But in this case, these guys swing up and down. So to answer Bernie's question, as I would play it, I would see it as something like a butterfly play. And that means if we go back to MU, whoop. Oh, see, there's a bad thing when they only go out to January. That's a problem. So I would that would exclude it from the butterfly. I wouldn't play it. That's your problem. Is they only go out to January? No, that's not MU. I was just gonna say the prices look wrong. There you go. Sorry, they do go out. All right. So, what are the facts of MU? Okay, right now the PE is 22. So 10% below this would be $42, let's say. So 42 is a price I'm definitely willing to pay for MU. That means I'm certainly willing to pay 40. And since I collect $8 for the 40s, I'm only paying 32. So that's kind of free. And then I say, well, what if I sell the 35s instead? The 35s pay $5.75. Do I want to collect $5.75 instead of $8? Do I want to collect $2.25 less? And the question is, am I that worried about it going down? Now, if you think about it, though, 35 minus 550, let's say 550 maybe. 35 minus 550 is 29.50. 40 minus 8 is 32. So this is 29.50. This is 32. That's the only difference between it. Is whether and either one I think is way too low for Micron. So if either one is way too low for Micron, why don't I collect more money? So I would sell those 40s, and it might seem aggressive, but you're selling them for $8. And I know you're going to use the money for something else, obviously. So you could say, oh, well, I'm still going to get stuck owning it at 40. And the answer is, yeah, you will. But the bottom line is you still treat this particular part of the transaction as that's just a put sale. And my put sale is doing what? I'm promising to buy Micron at 32. So I would do that. And I would use half. I would do a 2x on the top. I wouldn't apply it all. I would apply 2x. And I would go with, now, what did we say the range was? We said the range is basically 36. So you don't have to sell the 36s, but you say 36 is low. So you take the 40s at 14.50. And what if I went to the 35s? I always look $5 down to see what's going on. That's 17.50. So would I pay $3 to be $5 lower? No. We don't pay $3 for $5. We pay $2.50 for $5 at the most. So that's an easy decision there. How about the 38s? Those are a weird price. Those are $15.70. And would I pay $15.70 instead of $14.50? So would I pay $1.20 to be $2 lower? No, still same logic. It's more than half. I'm not going to pay more than half to be at a lower strike. That doesn't make any sense. I don't need to. Okay, I can pay less out, it'll be cheaper to roll down if MU goes down. And if MU goes down, I'll be happier I didn't spend more money up front. If MU goes up, I'll never get to roll it lower, but of course I won't need to because it went straight up, so I don't have a problem. So the 40s are fine, and then the 55s are, is that right? Yeah, they're 820 or 825, whatever. So if I've got, what do we say? So if this is 14.50 and this is 825, that's like $6 for the spread, for the 35.50 spread. So $6 for a $15 spread, but I sold these for $8. And if I buy twice as much long as I had the shorts, I'm getting a $4 credit per 6. So now I'm in a $15 spread for $2. Okay, I have the $15 spreads for net $2 with half the put sold on the spreads. And my upside is $13 at 50. So what does that mean? That means I'm super well covered, right? So now I say, oh, what kind of short calls can I sell? And I look at July and I say, they're at 46.26. I could sell the $50 calls for 220. Now, I don't want to sell all of them, so maybe I'll sell half. And if I sell half, I'm collecting $1.10 per long. How much are my longs? Net 2. So for each $2 long that I own, I'm collecting $1.10 back in my first sale. And I'm going to have 6, 7, 8 sales like this. And so I'm very happy to sell that. And look at these ridiculous put prices. So if we go to 46.50, what did I say we're going to sell? The 50s? Yeah, I said the 50s. Okay, that gives us a lot of leeway. And if I give it some leeway to the bottom, let's say, well, let's pick up another $2. Why not? Sell the 42s for 2. So in other words, now it's covering a 10% move either way, and we're still good. But meanwhile, now we've sold $2 per long. How much is that? That's 100% of what we laid out in cash. and we're collecting it in the first 58 days, and we have 600 days to sell. So logically, we can collect 10 times our initial layout back, plus we've got the benefit of the spread, which can pay us a fortune, 15 bucks, which can pay us 15 bucks each. So Bernie, remind me please to put that in the butterfly portfolio officially in our member chat room, because that's just a huge income producer. And there you go. And we're back to what kind of trades do we want to put into the new hedge fund? That's the kind of trades we want to put in the new hedge fund. That thing is just going to crank out cash, and the risk is so low. What's my risk? I own some MU. That's my risk, because I end up owning some Micron at a pretty good price. But otherwise, I can make, let's say I put $20,000 into it, right? I can make $200,000 back on sales. $200,000, 10 sales of what we were just talking about. So that's 200,000 bucks I can make there. Plus, if it's 20,000 of longs, then they're going to return $150,000 on the other end. So I can get 300. I can make up to I can get back about $350,000 on my $20,000 investment. Now, that's if everything goes perfectly well. Chances are everything will not go perfectly well. Okay, but that's fine, because you know when you've got $300,000 of potential gains, I don't need everything to go perfectly. If it goes 25% of perfectly, I'm going to make 50,000 bucks on 20,000 bucks. So if it barely goes right at all, I'm still going to do really well. That's why we like these kind of plays. It's not, I don't believe I'm going to make I don't even know the number, 15,000%. I think that's 15. I believe it's 15,000 or 1,500%. 1,500%, I think. So I'm not counting on making 1,500%. That's not my goal. Okay, it's not my expectation, but it's possible. So, you know, if everything goes perfectly, it could happen. Now, clearly in the butterfly portfolio, we only make 30-40% a year, about 40% a year. So it doesn't always go like that. Well, and also there's another factor in the butterfly that we don't use all our money. It's a very conservative portfolio. We always have cash on the side. We have $200,000 in cash sitting around. So, you know, we don't do super duper, we do plays that can generate tremendous amounts of money. And if they're generating the kind of money, as long as we're getting our returns, we don't tend to do much with it. And I know that frustrates people long term. Don't forget, as I said, this is a 2.5-year-old portfolio, and it's only got a few positions in it, but it's still making 40% a year. So we're not using all the power of the portfolio on purpose, because we want to be flexible. We want to be able to make adjustments. We want to stay safe. That's how this portfolio works. That's why it's our most consistent, safest, you know, smoothest performing portfolio, because it's very cautious, because we're very conservative, because we always keep cash on the side. We do everything possible to make this safe. That's why it's going to be great for this fund. We're going to set up a whole fund like this, and we're going to be able to take $100 million easily and just crank out cash. So that's the goal of what we're doing here. And those are the kind of plays. So yeah, definitely remind me about that MU play, because that's just really, really great return. So I like that. Good call, Bernie. All right, let's see. What else we got? Oh, we can look at the EI. Oh, the Fed's coming out now. The Fed minutes are coming out right now. And well, see what the reaction is to the Fed minutes. 5 minutes, we're going to see the Fed minutes. So for now, let's take a look at the oil futures. Dun, 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 dun. May 15th, that is correct. Okay. So what happened? Oil refinery imports, 12 million barrels a day. That's, well, you can see that's low. It was 16.5 last year, now it's 12.5. So about 4 million barrels a day less oil is going into the refineries. They are making, obviously, less products. So they were making just under 20. Now they're making 16. Well, duh, if they get less oil, they make less stuff, right? That's pretty obvious. So they're making 16 million barrels a day as opposed to 20 million last year. So that's down 20% from last year, for pretty exactly. We're exporting. Oh, look at our exports keep falling off though. We're only exporting 2.4. We were exporting 2.7. So exports are dropping off. That's bad for these guys because they can't get rid of it. All other oils went up 3 million. That's one little hidden factor. Overall, see, here's the funny thing, right? Because they're telling us that it was kind of flat, but when you look at the actual number, we went from 34 to 41. And that to me is 7 million barrels. Somewhere there's a 7 million barrel bill. They're saying crude decreased by 5 million barrels. They're saying gasoline increased by 2.8. And distillate went up by 3.8. And propane increased by 1.1. I guess we don't usually look at propane. And all other oils went up 3, which they don't count at all. So I guess that's where you get that number. But on the whole, it's a 7 million barrel bill. It's still pretty bad. So oil shouldn't really be holding up the way it's holding up. I mean, it's bad. But you know what isn't bad though? The rollover thing is not that bad this month. But I think this is too high. But as you can see, we're down to like the last couple of days of the May contract, and we're not getting that panic selling that we had last time. And the reason we're not though is because of the NYMEX crude. Is that the NYMEX WT? Is this it? Contract specs. Open high. No. Time and sales? No, that's not the one I usually look at. Nope. I fall for that every time. Market Watch, Markets, Bloomberg, EIA. I don't know. Hang on, let me check my other computer. It's like it's like always, you know, it's like one of those always tabs on my other computer. Man, it's raining again. Getting big, we're getting storms every day now. I guess it's better than a drought, right, California? La da 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 da. It's futures.tradingshorts.com. Let's try that. Futures dot trading charts. Commodity futures charts. That's not really the way I look at it. Oh. Commodity quotes, no commodity charts. I don't know why that's difficult. Brent crude, light crude, NYMEX chart. So how do I get to the other thing? It tells me all the contract information. Market quotes /CL. Intraday quote. Yeah, there it is. Haha. All right. Meanwhile, June has already been taken off the table on this thing. So the whole thing I was looking for isn't there. But this is the chart I'm looking for. So if you ever want it, it's this. Control C. And I think if I put it into this chat box, it'll do something. Where is that? Oh, just. There you go. That's how I look at my oil charts. So anyway, so the bottom line was, as of yesterday, not the volume, the open interest. As of yesterday, the open interest was pretty low. It was in the 30s, and that's pretty manageable for these guys. Also, they don't have as much bloat as they often do in the number of open contracts for July and August. September still has a bit of bloat. So, you know, as long as they can roll these contracts along to longer and longer months, they hope that eventually they'll go higher. They're okay. See how December's got a big log jam though? They're going to have problems in December if they can't really get this stuff fixed. But as of the moment, they've spread their contracts out over the next 3 months pretty evenly, although obviously 298 million barrels of open interest when we're only processing 16 million barrels a day. That's not going to work out very well, right? Because 16 times 30 is 480. So in the NYMEX, they've already got half of our crude supply in the NYMEX contract. Sorry, in the NYMEX contracts. That's a good. What did I say the number was? All right. Anyway, 480, I think. So that's a good portion of our total crude supply is already showing as open interest at the NYMEX. So that's basically fake. Okay, it's the same thing as like when you say you want, you know, it's the same thing when you sell a bunch of Apple puts. You don't really want to buy like 2,000 shares of Apple. It's like that. It's like these guys don't really want this oil. They will whittle down over the course of the month. That's what went wrong last month. There were too many open contracts. Oil started dropping. They couldn't get their price. Everybody started panicking. That's how it went. Up. Hey, Fed time. Commercial real estate transactions in the U.S. plunged 71% in April. Oh, here we go. Fed minutes. FOMC could later clarify intentions on rate policy. Uh-oh. That's not good. That's not what they want to hear. Some Fed officials said forward guidance could be more explicit. As you can tell, I don't feel like reading it. I'm waiting for the news to tell me. Oh, really? It takes you this long to discuss it? I could read it faster. That's it. That's the only 2 talking points they got out of these minutes. Well, I mean, nothing very inspiring in that. We'll give it a few minutes to see what other people say about it. Honestly, it's the same rehash of bullshit that they had last time. FedMo's outcome based on date-based forward guidance. What? Fed. March press conference minutes. No. That's the released April 8th. That's bullshit. Oh, that's weird. Here we go. Ugh, look at all this crap. Developments in the markets and market operations. No, we don't care about that. Staff review of economic situation. That's what we care about. Coronavirus outbreak measures taken to protect the public health were severely disrupting the economic activity. The available information for the April 28th meeting indicated that the market operations deteriorated substantially in March and April. This is good because they're talking about April because it was an end of April meeting. Real GDP declined sharply in the first quarter. In addition, a variety of economic indicators already pointed toward extraordinary contraction in GDP in the second quarter. Consumer price inflation measured blah, 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 remained below 2%. Well, job losses. I swear, it's like these are the best economists in the world. And they're like, that's what they come up with. Job losses surged in March, even though the drop in total non-farm pay. Look, I've been losing internet and power, like with sharp spikes. I just ordered a new UPS, in fact, and it's not here yet. So if this webinar suddenly ends, that'll be why. Because I hear like lightning like going all over. Job losses surged in March, even though the drop in total non-farm payroll reflected those changes and occurred through mid-month. The unemployment rate jumped 4.4%, only 4.4% in March. That's weird, right? Because we're like 20% now. And the labor force participated 14, 15, whatever it is, 16. After economic shutdowns, a development that pointed to substantial losses, nominal wage growth is moderate, hourly earnings increased, PCE inflation, core inflation, blah, 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 blah. University of Michigan is crashing. Wow, consumer sentiment in like Japan was, it was horrific. They are just, I mean, it's not just their current situation. Their current situation is horrible, and the outlook is worse. That's how the consumers are in Japan. Real residential investment expanded strongly in the first quarter, although they were trying to get ahead of the virus. Starts building permits, blah, blah, blah. That's all obviously out the window now. Whoa. What happened? Where was that? Second wave. Future performance would develop on the evolution of coronavirus. Staff observed that the uncertainty regarding the economic effects of the coronavirus was extremely elevated. Second wave corona. Okay. In this scenario, a more pessimistic projection was no less plausible than baseline forecast. In this scenario, second wave of the coronavirus outbreak with another round of strict restrictions on social interactions was assumed to begin around year end. This is crazy. Inducing a decrease in real GDP, a jump in unemployment, and renewed downward pressure on inflation next year. Compared to the baseline, the disruption to economic activity is now severe and protracted in the scenario with real GDP and inflation and lower thing, blah, 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 blah. So what the fuck is this? What is this? What is going on here? You know, I understand a lot of money is being pumped into the markets, but holy crap, people. This is some really unrealistic stuff that's being traded. And Powell just testified yesterday, right next to Mnuchin, and Mnuchin, that was the weirdest testimony I ever saw, because it's, I mean, obviously the GOP controls what goes on in the Senate, but I've never seen Powell always testifies to Congress, right? He doesn't testify with Mnuchin sitting on his shoulders, contradicting everything he says. That's what was going on yesterday. Whatever Powell said, Mnuchin would spin it. He had way more screen time than Powell. And they're sitting there at the Senate. And by the way, that was what was pissing Elizabeth Warren off, is Mnuchin would just start spouting bullshit and taking up the time. So he was, in other words, so what was happening was all the Republican senators who had nice, positive things to say would get to talk as much as they want. But when a Democratic senator said something, Mnuchin would say, let me just clarify that point. As you say, he starts repeating. You can see the technique. He's repeating what they're saying. He's talking about the possibility of that. He goes off topic and talks about something else, blah, blah, blah. And the poor senator's sitting there waiting to get back in, and they're blocking him out because it's all on Zoom. That was nuts. It's like you're being manipulated. The people who are watching these meetings are being manipulated. The press is even being manipulated. How do you get a quote out of somebody if you don't let them talk? I mean, it was insane. That was the craziest thing I ever saw yesterday. I mean, look, I mean, the two pictures in today's article that we were talking about. I mean, keep in mind, these pictures are from Powell's testimony. Powell doesn't get to talk. Mnuchin talks. Anybody with difficult questions, he took over. And I don't know if they told Powell to shut up or if they just basically clicked the mute button on him, but he was only talking to Republican senators who asked nice questions that would lead him in a good direction. And why is this being done? It's being done because they want you to believe, just like in Jaws, it's the same thing. It was a good, where's my Jaws thing? This one over here. That's what they want, okay? The so-called coronavirus is under control. It's a beautiful day. The beaches are open. We're all having a good time. Come on down, get in the water. That's what they're telling you. That's the message. And they don't want it to be an opinion. They want it to be the story. They want that to be the narrative that everybody follows. You know, the mayor of Amityville doesn't want they don't want half the people in the town protesting the beaches being open. They want everybody down there. We all got to pull together and go. And they're gonna start telling you to go out to restaurants. That's the next step. They're gonna tell you, why aren't you visiting these businesses? What are you doing sheltering in your home? They're gonna make it that you're unpatriotic if you're not going out to eat. This is all a huge manipulation of the public to shove people out there. And I don't know. I mean, I guess I gotta hope it works. I hope it works. I hope it's not a disaster. I hope everybody doesn't die. That would be nice. But I haven't heard too many actual scientists saying it's better. Oh, now that the Johns Hopkins person is being interviewed, they see a lot of cases cropping up in young people now. Oh, here's a good one. Virus 13 feet. There you go. And see that they're disinfecting the shoes on the kids. COVID virus can spread 13 feet and travels on shoes. Exhaled aerosol spread coronavirus 13 feet. What's aerosols? That's when people talk. You know how, like, if you're on stage, have you ever been to like a show and you sit in the first couple of rows and one of the actors is like, he talks so hard, like he's projecting so much that he's spitting a lot, and you like freak. Well, I am anyway. It's like, I'm like, if I see a guy like that, I'm like, oh shit. It's like, I don't want to get spat on by the actor. I don't know where that guy's been. Anyway, that's what they mean. That's what aerosols are. It's when you talk and you project out of your mouth, it's not regular breathing. It's you are pushing air forward out of your mouth. That gives you a lot longer range than 6 feet. So you're creating it's as if you're purposely blowing. Basically, that's how sound travels. And the louder people talk, the more they talk from their lungs, the more they project. It's all a force air out of your chest that you're pushing. And if you're doing that, you're collecting more viral particles, if you have them, at one time and expelling them in a breath at a forward direction. So the guidelines they have may not work. And if you try to give everybody 13 feet, basically everything's closed. In fact, I was at the pool yesterday at my daughter's hotel, and they were measuring 6 feet to keep the chairs 6 feet apart. And the guy had to take away, I felt bad for the guy who was doing it. They told him go out there and make all the chairs 6 feet apart. But in doing that, he had to take away about 1/3 of the chairs to make all the chairs 6 feet apart. And frankly, he was only making them 6 feet apart left and right, but they weren't 6 feet from the chair behind you or the chair in front of you. So the chair behind you and in front of you was only 3 feet away, and he was spacing them 6 feet apart. If they really followed the rule, it would be a lot less chairs. As it was, he had to take away about 1/3 of the chairs. Now, if you said 13 feet between chairs, there would only be like 10 chairs at the whole pool. They would have to take away 90% of the chairs. But that's what's safe. When they say at Starbucks, they go, hey, what's the drinking temperature of coffee? And the scientist says to Starbucks, they go, well, 200 degrees is optimal for coffee, and anything above 250 degrees will burn somebody's lips, and anything below, well, I mean, below, obviously below 32 is ice, so you can't drink it. So Starbucks says, okay, well, we'll keep our coffee at 200, right? Because that's what scientists tell you to do. If you want to enjoy coffee, it's got to be 200. This is the same thing. Scientists telling you, if you want to live, this is what you need to do. If you want to not spread this virus out of control, these are the rules. And we're saying, okay, thank you, Mr. Scientist. We're going to do this instead. That's like Starbucks saying, okay, well, it's nice to know that people can burn their lips at 250, but we're gonna go for 300. You know, we're gonna serve coffee that's not. I'm wrong about 200 on it. Where's Waterworld? 212. Huh. Now I want to know. I had 200 in my head. 250 obviously can't exist because that's steam. What temperature is coffee? 185. Okay, well, there you go. So it's a little narrower than I was thinking. Anyway, so 185. So obviously 212 is steam. There you go. So that's basically the limit there. But Starbucks says, but anyway, it's a fairly narrow range. So you just, so basically they just go, oh, well, we're going to serve our coffee at 210. Like, no, you can't do that. It's going to burn people. We don't care. It's not a whim. These science guys don't like just make up shit. They're like measuring this stuff. They're telling you that this is how you stay safe. This is how you don't stay safe. And I don't know what's going to happen. Oh, look at this. McDonald's. Oh, McDonald's is earmarked 40 million. How bullshit is that? McDonald's has earmarked $40 million in aid for restaurant owners. But they're also telling them that assistance is available on a case-by-case basis, and franchisees will have to come up with solutions. And if you aren't able to deal with the situation yourself, McDonald's will consider shutting your franchises down or taking them over. Isn't that nice? You know what that is? JP Morgan return asset. Oh, come on. JP Morgan. Shit, what was it? Anyway, JP Morgan said something like JP Morgan assets, quote. Equity? Is it equity? Damn it, what do you say? Anyway, this guy, he's my favorite. I love him. So, JP Morgan said something to the effect of that a recession or a crisis is a good way for capital assets to be returned to their rightful owners. In other words, rich people during a crisis will take back everything they sold on the market. That's when they take back. So in other words, when times are good, they sell their assets and get top dollar from all the people. And when things go bad, they buy all those assets back for pennies on the dollar, and they wait for the next upturn and do it again. That's how it works. That's how it's worked since the Magna Carta. The Magna Carta does the same thing. The Magna Carta was a way, in the end, that the upper class would sell their land to the peasants, and the upper class would know. They knew how to manage their land, so they would, they managed their land forever. So they knew how to manage their land. They have to save during good times, and then in the lean times, they would have to dip into their savings and cut through the lean times and then try it again. As the peasants demanded land, what they decided to do, the nobles, was like say, oh yeah, well, that's a great idea. Screw these guys. They're like, we'll charge them top dollar for the land. At some point, they're going to run into financial distress on the farm. Then we'll buy the farms back and we'll rent it to them. Or, you know, it used to be they were serfs who worked the land and kept a percentage of the food and ate and lived and had houses and so on. Now instead, no. Now you got to pay for the land that you live and work on. And now you're going to pay me taxes instead. It's very interesting. Capitalism is a very interesting thing. It's really just another way to extract money from poor people, but without actually calling them slaves. Oh, here's Morgan in action. Get off me, you poor person. He's so great. Anyway, so that's where we're at. And McDonald's exercising some capitalism right now. But I honestly, I mean, you look, we hedged on when was this? Friday. And I sent out a top trade alert. Oh yeah, so that's a good place to look at it. I would take this stuff really seriously, guys. That's why I made a top trade alert. Oh, we picked a new stock for Foot Locker. Berkshire. Oh, wait, I swear I sent out a top trade alert. SPG. Oh, I know what it was. No, I sent out, it was a email alert that's different than a top trade alert. Okay, so we have to actually look back at Friday's post. If I send something as an email alert, it's not the same as a top trade. But I want to make sure everybody got that. Our short-term portfolio adjustments. So here's the short-term portfolio, and it was, no, that's a long-term portfolio. Damn it. Was it Monday? Sorry. No, maybe it was yesterday. Ugh, that's the problem. These shut-in crises, everything's the same. All right, here we go. So I had just done the review a week ago. Yesterday we were at 447. Today we're at 434. So down a bit now, which is fine because we're being more aggressive. And meanwhile, did the long-term portfolio hit 40? No, damn it. Okay. Anyway, short-term portfolio. So, you know, the short-term portfolio is designed to make a lot of money in a crisis. It made a lot of money in a crisis, and then we cashed it out. And then the long-term portfolio came back. So it all worked out fantastically for us. That's not really the intention, but if we time it right, that's how it works out. What was the point? Was it comments? No, it was here. Okay. So, you know, what do we do and what do we have? We bought back the short June calls on the SDS. Short June? Oh, down here. Sorry. So we bought back the short June calls, and that's all we did there. With it doesn't matter what we do with Chipotle. Chipotle is just a tradey play, and SQQ. Now on SQQ we did a lot of stuff. We killed the spread, or I'm sorry, we cashed in the June 13s, took that money off the table because that money at the time was where are we? QQQ. Here. So that money at the time was only 43 cents. It wasn't much money. So we cashed those in and we left the short ones to die. We rolled our $10 calls to the $5 calls to put them in the money. So we have to, and 15, remember I said 16 is as high as we're likely to go. So there, now we have the 5-15 spread. and we cashed this out for 430, moved to a 420 spread, so it's an even roll. And we rolled the short puts to more short puts, that's fine. And that's the only change we made, so that gave us a bigger spread. And we're deeper in the money. We added, now, why did I add TQQQ? And why did I not put a chart up for it? I don't know. I put SQQ up twice. TQQQ is the bullish Nasdaq Ultra, and the thing about that is because it's at 80, or it might be a little higher now. Let's see where it is. Because it's still at 80. So because it's at 80, and it's also 3 times Ultra, if the Nasdaq falls 10%, this will fall 30%. 30% of 80 is 24. So this will fall $24. And remember, my problem with SQQ is it can't go low enough. And that's what I did. You know, when I'm thinking about it, I said, oh, well, if SQQ can't go higher, then TQQQ can go lower. And so we switched to TQQQ. And now we're shorting TQQQ instead, but only a small portion of what we're doing because it's kind of scary. It could go spiking up also if the Nasdaq rips back up. But I don't think it will. I think we're going to be topping out here in the wherever we are, 9,000 something 9,500. I think 9,500 is quite enough. So we're playing it bearish here. So 80, 55. And what I say it could fall 24, right? So that's exactly where we're going to be. So if it falls 24 points on a 10% drop in the Nasdaq, then we're going to pick up the full $25 on this spread. We paid $10.40 for it. We paid $52. We get 100,000 plus 75,000 extra protection on that one. And we sold some June puts though to lower the basis. So now we're knocking our basis down to $40-something thousand. So that's our new spread. That's our new hedge. And if it goes higher, of course, we're going to roll it and fix it and so on and so forth. But the point is, we have the protection in case something bad happens. USO, we cashed out because I didn't know if it was going to go up in its expiration, so we gave up on them. And UNG, we're still in. And how is UNG? I think somebody asked something about UNG today. Oh, JCS. UNG is cheap again, 1164 today. I understand that less oil production means less gas production, but given the recession, can you explain the reason behind your UNG play? Yeah, exactly what you just said. Less oil production means less natural gas production, and we still use a good amount of natural gas. Not using, they're not the same thing. So in other words, when you heat your home with gas in the winter, you can't say, I'm going to use oil instead because it's laying around. You still need the natural gas to heat your home. You still need natural gas to make chemicals with. You can't make natural gas with crude oil instead. It doesn't matter if it's a better bargain or cheaper or something else. So the natural gas demand and running electrical plants. Actually, electrical plants, some of them can switch, but mostly a natural gas plant's a natural gas plant, and it requires it for energy production. So there's a lot of demand inflexibility in natural gas, that less so than oil. We haven't shut down those kind of things. We don't run cars on natural gas. We don't run airplanes on natural gas. So I believe that natural gas production demand will be steadier than oil demand, and the production is certainly slipping along with oil. So I think down the road it's a better bet. And you're saying what? This is a 2022. No, I'm sorry, it's not. It's January. This is a January 12-15 play on natural gas. We're not expecting a miracle here. We're expecting that UNG makes it back to about 15. That's not historically high. Usually in the summer, it'll start peaking up into the fall, and especially, oh, and by the way, of course, hurricane season is a disaster. So if you get into hurricane season, which starts soon, It's already that time of year. You get into hurricane season, you start having disruptions in the natural gas supplies, and then that can spike the price at any time. So I think there's a good floor in demand, and we're probably near that floor now. And I think that there's many possibilities that can get us to move higher. So I think it's a good risk reward play. That's all. So what else is going on? Anything exciting? JetBlue has not furloughed their employees. That's interesting. I don't know anything about that. So what were we looking at? Short-term portfolio, right? All right, well, so that's pretty standard. So then, like I said, basically we just added a hedge. We want to be a little bit more hedged because we want to protect. We're protecting the constant gains. Every time the long-term portfolio makes some more money, we want to protect it. And by the way, the short-term portfolio doesn't just protect the long-term portfolio. The short-term portfolio protects any of these portfolios, and you just proportionally would adjust it down depending on how much money you have in the other portfolios. But this hemp Boca portfolio we're killing about 15%, but we don't need it. Futures now is doing great. That's a good portfolio, 26%. We only started that in December. Earnings portfolio is doing very well. That one is self-hedging. The earnings portfolio has its own hedges. It has the SQQs in it. So that even reflects the losses from the hedges. Well, there's no actual losses yet. Along with the plays. And again, this one's only from 1021. We're up 90%. And we're just doing opportunistic plays on them. You know, stuff is not very complicated, frankly. The dividend portfolio is terrible because, you know, companies cut their dividends and they get killed. But minus 23% is really not bad. These are all 2022 plays, or almost all. Oh, China Telecom's is almost due. I think we already adjusted it though. But these are basically 2022 plays. See, 202222222222. So it's nothing to panic about. It's down 20%, but a lot of these things were called away at below where they were. So in other words, 823, we sold the $5 call. So we don't care if it's 823. I don't care if it's $100. We're still only going to get $5 on the calls that we sold. So we never planned for that thing to be high. $35, these calls are going to expire worthless. We'll have to roll the puts. Altria, we sold 4750 calls, so those are too low. But like I said, it's like if it comes back, that's fine. Simon Property, we sold the 65 calls, we're way below that. AT&T, we sold the 35 calls, we're way below it. Ford, we sold the $7 calls, we're not there. Macy's, we sold $13, $5 calls, we're at 5. And we'll have to roll the puts, of course, at some point. Signet, we're waiting for them to get a bit higher. Looks like they tested 10 on us. SI. Signet. Whoop. Yeah, they did. They tested 10. Okay. And Tanger Family Outlets, factory. And they are just under $6. Love those guys. And we don't have any short calls there, so we're aggressive. So we'll see. I mean, if there's a real recovery, this thing's going to explode upwards. But even if it doesn't, we're going to collect the dividends, and I think we'll do okay. You know, there's a long-term holding strategy on that thing. Oh, so that leaves us with what? Anything else to look at? And then with the butterfly, we already looked at the butterfly, and that's doing fantastic. So that's all it takes. Our portfolios are in pretty good shape. We are extremely well hedged. We would almost prefer that the market goes down before it goes back up. But if it's going to keep going up, then what the hell? We got plenty of long positions. We're aggressively long in this portfolio, in the dividend portfolio. Obviously, the long-term portfolio is making incredible amounts of money on a move up. that means we have very, very little to worry about right now. I'm just really more socially concerned. I'm not market concerned. I'm socially concerned that what we're doing is a mistake. And that is why I feel a stronger need for protection. I'm not going to go crazy gung-ho bullish on stuff, but look, if the market doesn't go down, we're going to add a position here, add a position there. Yesterday we added Foot Locker. And this isn't all we added, but I'm just talking about top trades. Of the trades we add in member chat, the top trades are the ones that I like the best for the week, basically. So yesterday we added Foot Locker. I thought they were too low. They're up another couple of points today. So I was like, this is kind of silly. I think they're going to break out of this wedge and start going higher. Yes, they're a mall store. That's a problem for them, but they're doing a lot of online sales. And eventually people want shoes. That's all there is to it. It's not a complicated premise. They're one of the retail companies I think will bounce back quickly because they provide a needed item. It's not like Abercrombie and Fitch. You don't necessarily need that. But Foot Locker isn't a brand. They sell sneakers. They sell lots of different sneakers. People need sneakers. That's all there is to it. So people wear them. They need more. Foot Locker is a major source of that, and also they don't have a heavy inventory load, so they're not getting killed holding the stuff. They're a just-in-time sort of a retailer. So I think that they should probably be able to manage their way through this thing. Their financials are solid. What I say the number is $28 for them is $3 billion total market cap. And look at their net profit. 520, 540, 600, 284, bad year for whatever reason. They did some crap. 541, 491 projected this year, 413 next year. Okay, that's still 400 million on a $3 billion investment. That's still a great return. So I just think this is ridiculously low. They're going to weather the storm. We aren't being aggressive. We went 25, 37. 25, 37, 50 is our target in 18 months. And we did plenty. We only sold 10 puts. And if this starts going well and we get up into like the 35 range, we can start selling calls against it and getting an income. I love getting an income. A couple of weeks ago. So 2 weeks ago, we don't do top trades. I don't force top trades. When I have something, I put it up. If I don't have something, I don't put it up because I only want them to be things that are very, very likely to make money. So we went for Berkshire Hathaway 2 weeks ago. The week before that, we did SPG is Starwood, right? No, Simon Property, sorry. That's Simon Property, so they're a REIT. I don't know how they've been doing since. SPG. Hello? What went wrong with this thing? How weird. Okay, so they're just kind of chugging along. Nothing exciting happening yet, but I like them. So that's still playable, obviously. We had an SQQ hedge on April 17th and a Tesla trade too. That's a Tesla and the STP. Bed Bath & Beyond on April 16th, which is here, and they're nudging up a little bit. And what do we get? We got the 310 spreads. So we paid $2 for the 310 spread, 3 and 10, and we're at 6. So they're $3 in the money. So that's nice. We sold the $5 puts. We're on track there too. That's nice. I like that trade. Did I forget to put that in the LTP? Because I don't remember seeing that. I think I might have to add that. Sometimes too much stuff going on. Yeah, I forgot to add that one. I like that too. All right. So that's two things to note, Micron and Bed Bath & Beyond. Back on April 13th. What do we have? Cheesecake Factory? Ooh, I don't know if they're doing so good. Let's see. That might have been a mistake. I mean, not a mistake, but I mean, certainly not performing well yet. I try. I prefer it if they go well soon. Oh well, yeah. I guess considering where they were. So here's mid-April. I don't know which one they were, but they're flat or up a little bit. It's all right. And what else do we have? Alaskan Airlines. Now we've dumped out of airlines, so this is an off trade now. Oh, look, that was back when LK was first getting a trading halted too. How are they? I think they're about dead now. I think they're delisted or got a delisting notice. LK. Yep, can't even get a chart. So that was a good short. Let's see. Here's stars. They really took off. Holy crap! And that went phenomenally well. Obviously, Comcast was April 2nd. I'm sure they're doing good. Oh, here we go. April 2nd. Oh yeah, look at April 2nd, way down here. That one's doing great. Wow, all of our top trades are phenomenal, huh? AT&T, not much there. End of March, down here, just up a little bit. Nothing exciting. But this was actually not the. Oh, look what we did. Let's see, we sold the June 30 calls. Oh, so we're actually in good. Oh wait, puts. So 100 June 30 puts. One of those was supposed to be calls. They wouldn't have both been calls. 50T, what would I have done? Wow, I screwed that up and nobody told me. Sorry about that. Okay. So boy, I mean, generally though, good group. TIVA, VAC, and USO from March 23rd. TIVA certainly did fantastic. Oh Jesus, look at that thing. That was a good call. VAC, that was a good call. Valero, obviously a great call. USO. Wait, when was this? To be fair, let's see. March 23rd. Nope, that didn't work out. There's March. Wow. Oh, wait, USO. And it's funny to see Valero went up. USO not. So Valero March 23rd was down around here. I mean, USO. That's not too off. Could have done better. March 18th, I called for hedging, which was actually really well timed. Mountain. Oh, that's a good one. I like them. Holy cow. When was that? March 17th. I'm telling you, these top trades are a freaking gold mine. March 10th, 6 and Apple, 6 flags. Wow, I picked 6 flags. That's interesting. So they're kind of flat from March 10th. And Apple, of course, obviously brilliant. A little early with both of those calls. They had to weather a storm. And oh, good old WBA. Wouldn't be a good month if I didn't call WBA. Now there's one that's still good for a new trade. They're still down from where it was. SunPower I pick every single time. SKT I picked again. Discover Financial. Now when was this? This was January 31st. Nope, that's terrible. Look, there's January 31st. So they fell off like a cliff. Viacom from January 31st. Where are we? Wow, much lower. See, now we're into something that didn't work. So at the beginning of the year, we picked some things that were not doing good. Middleby, oh no, Friday, January 17th. Look at that. You know, now of course these guys are in the long-term portfolio. What we did is we just made a much bigger position out of it. You know, so for the LTPCI we started 10, 10, 10, and now we're 20, 20, 20 had much lower strikes. So we doubled down and we rolled down and we turned into a much bigger position. Oh yeah, we sold this. Thank goodness we sold those calls, right? So no, so we left the calls and we doubled down on the puts and rolled them, and then we took the other calls and we pushed them down to the 30s, and then we sold some 50s to pay for it. And now the position is net positive. You know, and that's fine. See, if you start with a position that you can easily double down, that's what's good about it. Even if you do have it, this is a catastrophe, obviously. This is a catastrophe, but what we did is we fixed it. So yeah, there you go. So whenever you're bored, if you want to look for things to trade, I always suggest top trades. Look for the ones that didn't go well, and you know, look, considering we've been doing top trades, and I used to do reviews for them, but I stopped doing it because everybody said it's like bragging. People didn't like. People said I was obnoxious. I like bragging in top trades. It's always and it's not. I'm not bragging. It was like we were consistently in the 70 to 80% range of successful trades. You know, and that and that's because I'm only picking once in a while something I think is a really compelling argument. And so it's very much worth considering if you're looking for something to trade to just go back through the recent top trades and look for ones that haven't performed yet. And that way you got probably a pretty damn good stock. And of course, ask me in chat and we can update it. But you know, you got a really good stock that I had good reasons for liking at the time, that I felt strongly enough about to make it a top trade, and yet it's cheaper now. Like Middleby. Middleby's fantastic right now. It's still ridiculously cheap. Viacom's still ridiculously cheap. There's still things in there that you will that are you know so easy to double up on in the next 18 months. So if you want to make 100% in 18 months, take a look at these trades, figure out which ones you know you want to play, and we can construct something that's going to make some money. But we are rarely missing on these top trades. We're really very close to 80% on a regular basis, going back for years. And again, that's not even including the fact that you can fix them. So like Middleby is considered a one that went wrong in the way I would have reviewed it in the past. It would have been one I would say was a bad trade, but it's not really a bad trade because it was very easy to fix. We rolled it, we fixed it. And that goes back to scaling in. If you go to the strategy section, so there's an article on scaling in the strategy section. And it's very in depth. It's old also because you can see Paris Hilton there was current at the time. I don't know if that many people know who she is anymore. I don't know if my kids know who she is. I don't know when this is from. Oh, here it is, 2009. There you go. See, it's from 2009. Half my kid's lifetime ago. And yeah, I'm a bad self-promoter that way because like I don't like rewrite articles. Like if I wrote an article 10 years ago and it says what I wanted to say, I'm like, yeah, well there you go. I wrote it 10 years ago. And there's some search engine optimization guys that consult with us sometimes, and they're like, yeah, but you got to do it fresh and you got to change some words and blah blah blah. And I hate that. It's like I said it already. I don't want to write it again. So I'm not very good at that self-promotional stuff actually. But anyway, but the bottom line is, you know, if I wrote it, there are many good articles in here in the education section, the strategy section. I don't tend to repeat myself. If I wrote it, I wrote it. And sometimes you got to go back real far, and you'll find stuff. But this is like simple stuff, okay? I mean, it's really just a matter of like pay attention, scale in, you know, diversify, scale in, pick some good trades. These are all good trades. There's tons of good trades here. The portfolio reviews, tons of good trades there. And I say, good for a new trade, good for a new trade, good for a new trade. All right. In fact, if we go to the long-term portfolio review, from Friday. You know, and if it changed drastically and you like the idea, then talk about it in chat and say, well, what would you do right now? Good for. All right, so here's 8 times I said it on Friday. Beyond Meat, good for a new trade. Sun Power, good for a new trade. Oh, not there. Nope. Oh. ACB, good for a new trade. Broadcom, good for a new trade. Berkshire, good for a new trade. Textron, good for a new trade. All right, so 5, I think that was. So, you know, there's 5 trades out of 20. It's 1/4 of the long-term portfolio, still good for a new trade. Anyhow, so that's where we are. We're up 374 now on the Dow. It's 1.5%. Nasdaq's up 2%, chugging along. And that's a good way to go into the holiday. We got some cushion. YM. As much as I'm worried about the virus, there's not going to be nothing will prove that. You have to, you can look at what the government's doing. You say, oh, the government's lying, and there's no real vaccine, and blah blah blah. But that's the truth, and the truth is not a major factor. As much as I'm a fundamentalist, you have to take into account fundamentally that the truth is not important. Not only that, though, there won't be compelling data to show that the government is making a mistake in easing the lockdown restrictions until at least 2 weeks. And even if it's 2 weeks, we already have evidence that Florida has been manipulating the test data. Texas has been manipulating the test data, and some other state that I read was manipulating the test data. So you've already got effectively a conspiracy of Republican governors who are going to pretend that the lockdown, that the easing restrictions is working, even if it's not. So my premise originally was it would take 2 weeks for us to find out if the lockdown wasn't working. Now it's going to take maybe 3 weeks, maybe a month. You'll still find out eventually. It'll come out. But then what will happen? It'll be a scandal. You'll have testimony. They'll have Congress. The Republicans will say it's a witch hunt. Blah, blah, blah. It can drag on for 3 months before anybody actually realizes we screwed up. Meanwhile, you got to enjoy the ride. It'll go as long as it goes. So I mean, this is a gift. You know, it's a real gift. And again, if you hated being down in the last crash, and now you're back up and you're near even or you're ahead or whatever, it's like, think about what you're risking. Maybe if you're not sure, maybe take half off the table. I mean, as I said, I'm hedging, but I'd honestly feel better just cashing everything out. It's crazy. I don't think the risk is worth it. And at the moment we're hedging, and so far things keep going up and things keep going up, but I'm very concerned. I'm very concerned about the world situation. And now we're coming into Friday and we're going to be closed for 3 straight days while the rest of the world is basically open. And, we don't know what's going to happen then. And the China's got their People's Congress. They're going to say stuff. Trump is crazy. He could say something at any moment. But on the bright side, we got through earnings season without totally collapsing. We're getting to the tail end of earnings season. So there still is a case to be made that we could go up further from here on a total, with Jean-Luc's charts. If we go back to the top of today's post. The NASDAQ effectively fully recovered. 9,455. So NASDAQ right here. I mean, there's the line. It's right up around here, as high as it's ever been. These guys have to get over their DMAs, these 200 DMAs, the red lines. But if they get over that, there's no reason they wouldn't be as high as they've ever been to. Is it justified? No, not at all. No possible way could you tell me it's justified. But it doesn't matter. That's where the money's going. All this money sloshing around, all this liquidity they're adding, it isn't going to work. It isn't going to create jobs. It's going just into the markets, into the companies, and they're using it to create profits, not jobs. And that's what Warren and the other senator were so pissed off about yesterday. And Mnuchin's like, screw you. That's what's happening. He said that's what you agreed to. That's what he said. He goes, because in a crisis, it's so funny. It's like the Iraq war, right? It's the same thing. It's like, that's what you agreed to. It's like, well, we were attacked. Everybody was freaking out. So we voted to go after this guy, Osama bin Laden, who was supposedly in Iraq, but turned out not to be in Iraq at all. He's in freaking Pakistan. And they're going to hang that on Joe Biden. That's the funniest thing, is that's one of the ways the Republicans are going to go after Joe Biden in this election. He voted for the Iraq war. Out of all the things, Donald Trump said the Iraq war was a mistake. Joe Biden voted for the Iraq war. Why did he vote for the Iraq war? Everybody voted for the Iraq war. It was freaking the big patriotic thingamajig that we were doing. All the Democrats said that. They were like, we object to this. We think it's wrong. But if this is you're claiming that you have the intelligence and so on and so forth, and we're not going to stand in the way of our president, we're going to vote. That's what ruined it for Trump, really, though, is that they did. They all the Democrats went along and voted for the Iraqi war, and they cast their votes. They wanted to show a united front of Americans all behind the president, and that was a total disaster. And it turned out that Bush had lied. They had made up information, so on and so forth. So they were like, we're not doing that again. And that's it. And that's how you have this massive opposition to Trump now, because the Democrats realized it was a huge mistake to get behind the president at all costs. Didn't turn out to be worth it. So we'll see how this one unfolds. It's going to be a lot of fun. Let's see. Jeff says, I don't have the chat option. I can't see the chat going on, or is this the chat? This is not the member chat. The member chat is under the day's post. So in other words, if you go to philstockworld.com, okay, and you go to my article. So here's Phil Stockworld's main page. You click on the article, and at the bottom of the article is our daily chat. That's just the comment section under the thing, and you can see like moderators, administrators are in colors. These are people who are, whose opinions are extra valued and whatever on the chat room. And then you got the news has its own color. And then I have my own color. So that's how you know it's me talking. And basically people ask me questions and I answer things as much as I can. Or I just ramble on my own, either way. But anyway, that's chat. This is only once a week we do these webinars. But anyway, welcome, Jeff. Hi. Should you scale in with the new hedge fund? Well, the hedge fund's going to scale in. I mean, that's up to you, though. I mean, obviously, you look at it as an investment. Right? So if you're looking at the hedge fund as an investment that you're going to decide how it's going after a period of time, you may want to scale in, like say, I was going to put in 500,000, but I'll start with 2, and then I'll see how it goes. On the other hand, though, this is a really good opportunity to buy a lot of stocks. We're going to be jumping in. If you come in later, you won't get as much of the benefit as coming off the bottom. And of course, obviously, we are internally going to scale into positions with the money. We're not going to take all the money and throw it at the market right away. We're still going to scale into positions. So, it depends on how you look at it. Do you look at it as, I want my money used this way, and here's the money? Or do you look at it and say, well, I consider the fund itself to be like a stock, and we'll see how it goes, and we'll test it out first. So that would be the decision you have to make. All right, but thanks everybody. I appreciate it, and we will do this again next week. Okay, take care, and have a great holiday weekend too. Oh, let me make a pitch for that. My daughter drove to Florida. First of all, very logical of her. She's like, I got time on my hands. She's actually not even. She's still doing schoolwork. She does her schoolwork during the day. So she drove to Florida, and they stopped in Charleston on the way down. So they had they drove 12 hours and 12 hours basically in 2 days. And she's like, well, I just would have sat around the house anyway. So what's the difference if I was sitting in the car? So they just decided to take a trip down here, and they're staying in a hotel. Again, I don't want them in the house because I don't know that they're being as careful as I am or whatever. So I'm not taking chances. So she's staying at a hotel down the street. They have a nice pool with patio benches. I picked it for that reason. But I got to tell you, from my own point of view, it's so nice. The hotel's totally empty. Not totally, but I'd say 10% occupied at most, not even. So the hotel's pretty empty. Then none of the restaurants or any facilities are open except the pool. Pool's wonderful. And it is just so freaking nice not to be in my house for periods of time. And again, it's if you pick the right place where there's a nice open pool, an open patio, a place you can sit out and have some lunch. You have to make sure food's accessible. There are a lot of hotels that are too remote and don't have good deliveries or whatever. You want to be in a place where you can get food, because the hotels may not have a restaurant open. But I'm telling you, for the money to just even if you just check in somewhere on a Saturday morning, or Saturdays at noon or whenever they let you check in, and you stay until Sunday when they make you check out, and you just hang out somewhere else for a day. It's amazing how refreshing it all seems. So I do recommend that. Obviously, we pick a nice hotel. We want to make sure they follow all the rules and everything, but just to get out of your house for a couple of days is the most amazing thing. It really is. It's totally worth it if you want to get your sanity back. And you're not going to do anything much different because you're locked down in the hotel too. It's the same thing, but I get to sit on a beach and read the book and relax, and just nobody's around. It's exactly what I wanted. I'm in the pool. There's nobody else. There's 2-3 people in the pool. I'm fine with that. And they say the chlorine kills the virus anyway. And the hotels, all the employees in the hotel have masks, and they're all using gloves, and they're all cleaning constantly. I felt very good about being there. I felt that was fine. They were certainly as careful as anybody in my building is as far as keeping surfaces clean. And there were way less people in the hotel, so that's why I felt better about walking around there. And the doors open automatically, so I don't have to touch them. That's what they need to do. They need to do that in buildings, is put automatic doors in. But anyway, so that's my advice for the weekend. Is if it's a 3-day weekend, even if you're working, you've got some time off. There's so many things. There's so many deals. My daughter was looking on Groupon. That's how she got her hotel in Charleston, and it was like $100 in what would be, I'm sure, a $200-300 hotel normally. There's a lot of great deals, and it's just so worth it to just take a mental break and get the hell out of the house. So anyway, have a really good weekend, everybody, and we can share our adventures when you come back if everybody goes away. Think about it, going away, not being home. And I'm telling you, the hotel's down the block. It feels like I could have gone to. It could have been the Bahamas. Just as good for me. Just get out of the house. It doesn't matter. Pick a nice hotel that's a mile away from your house. You'll feel so much better. All right, take care, folks. Have a good weekend.